Hello, welcome to this lecture on IAS 28, Investments in Associates and Joint Ventures. Investments in Associates and Joint Ventures. So we have already identified that when an investor invests and the investment gives significant influence, the investor must apply the provisions of IAS 28 to account for the investment. When an investor invests and it gives joint control, and the joint control is classified as a joint venture, the investor must apply the provisions of IAS 28 to account for the investment in the joint venture. And so this standard accounts for investment in associates and joint ventures. Right. Now, when we talk about applying IAS 28, it means the investor must use equity accounting method. Equity method to account for the investment. So you want to know what equity accounting method is and how do you actually do that accounting. It means initially determine the cost of the investment. Then subsequently add to the cost or subtract to that cost the post-acquisition investor's share of profit or loss. So start with the cost of investment and subsequently add post-acquisition share of profit or loss of the investor. If the investor receives any dividend, you deduct it from the investment. So this whole calculation we are discussing here, we'll see a bit more detail of it. This whole calculation we are discussing here is the equity method. You determine the investment at cost, and then after the first day, initial recognition, subsequently, every year end, you add or subtract the investor's share of post-acquisition profit or loss. If the investor receives any dividend, is deducted. The investment could be impaired, you deduct it. There may be unrealized profit on the investment, you may deduct it. So we'll look at the detail, but in a very simple term is that initially measure at cost and subsequently add or subtract the investor's share of post-acquisition profit or loss and deduct any distribution or dividend from the investment. There are exemptions, and it is exemptions when an investor may not apply equity method. So you identify those exemptions. And then when the investor will stop using equity method, discontinuation of equity method. When do you stop using equity method? And then also take note of the disclosures that the investor must make regarding the investment. Disclosures that must be made regarding influence. Now look at the definitions. An entity over which the investor has significant influence should be interested in how to know significant influence, just like you have to know how to assess control. How to assess control. What do you see in order to conclude that there is control? Again, in associate, what do you see or what are the conditions that will indicate that the investor has significant influence? So you take note of that. The investment may be impaired, and when it is impaired, it is deducted from the investment. Now let's look at the detail of this standard. So here we have already defined equity method, which means you initially account for the investment at cost, and then you adjust for the investor's share of post-acquisition profit or loss of the investee. So this provides you further detail of the same thing. And in all this, we are talking about equity method. Equity method. Associate IAS 28 means equity method, and that's how you account for it. Determine the cost, determine the post-acquisition method, add the share, post-acquisition profit, add the investor's share. If there is any distribution received, the distribution, for example, dividend, then it is reduced from the investment and it is shown as a non-current asset in the consolidated statement of financial position. It is one figure. So you calculate the equity method helps you to calculate the figure, and that one figure is shown as a non-current asset. So under non-current asset, you put the investment in associate and then you put the figure there. Now, you must remember associate will never be consolidated. Associate is equity accounted. Consolidation is for parent and subsidiary. Consolidation is for parent and subsidiary. Associate is only dropped as one figure in the consolidated financial statement. So in the statement of financial position, one figure under non-current asset, and in the statement of consolidated income statement, that's consolidated statement of profit or loss, another comprehensive income, in the consolidated profit or loss and other comprehensive income, it is shown as one figure. One figure. Okay. Now, this is an example of consolidated income statement with an associate. So it means we are discussing a parent, a subsidiary, and an associate. Parent, subsidiary, associate. You consolidate the parent and the subsidiary. You consolidate parent and subsidiary, and that means you add parent asset and subsidiary asset, add parent income, subsidiary income, add parent liability, subsidiary liability, but you only show the associate as one figure. One figure. So you do calculate the figure in workings or in the notes and you show it as one figure and you provide the explanation as a note to the account. One figure. You do not add associate assets. You do not add associate income. There is no associate sales included. You only show associate as one figure in the consolidated financial statement. Now, when we talk about calculating one figure and using equity method, this is the way you go about it. Initially at cost. So on day one at cost. Subsequently, you want to know whether your investment is increasing or decreasing. You add the investor's share of post-acquisition profit or deduct the investor's share of post-acquisition loss. So it could be profit, it could be loss. If the investment is impaired, you deduct it. If there is an unrealized profit, you deduct the investor's share of the unrealized profit, and you deduct it here if it is the parent who is the seller. And then if there is any fair value of the investment and there is additional depreciation, so take note that it's only the additional depreciation we are dealing with. We are not dealing with the fair value itself because it is recognized in the cost of the asset. It is paid for in the cost of the asset. But if there is any additional depreciation due to fair value adjustment, you deduct it. So these are the details of it. Now you need to know that an associate is not a subsidiary. An associate, we do not have control, and therefore transactions and balances between parent and an associate are not eliminated. Now when we talk of parent, it means the investor is a parent and has a subsidiary and has an associate. So if you have the three scenario, You deal with the parent and the subsidiary in consolidation, and you deal with the associate. And so you don't eliminate transactions and balances between parent and associate. But remember, transactions and balances between parent and subsidiary will be eliminated. So take note that in an associate, they are not eliminated. When you receive dividend from an associate, you must take out the dividend, because in place of the dividend, you will take a share of profit. You can't take share of profit and also take dividend. So you replace the dividend with the profit you are taking. Now, if there is an unrealized profit, this is what will happen. For the associate, if the associate sold the goods, we will take it out from the group inventory and debit it to the associate profit. If the parent sold the goods, we will debit the cost of sales or group retained earnings and will credit investment, the investment in associate. So you take note of that. For disclosures, you refer to IFRS 12 for the disclosure requirement. There is something I want to highlight. When you are dealing with an associate, remember it is because of significant influence. And I have mentioned again and again that you need to read on the evidence of significant influence. 20% to 50% is assumed or presumed as significant influence. So if the entity has 20% equity interest or 20% voting power and above, it is assumed to be significant influence. Significant influence. Representation on the board of directors, participation in the policy making process. Remember, participation, you have a voice, but you don't take decisions. You are not in control. So take note of that. Thank you.